We welcome all of you to the online refresher course in the University of Mysore. This is the
Good
first.
afternoon, sir. Good afternoon.
Good afternoon. This is the first program we are conducting in the University of Mysore for this academic year. Today, I'm going to present two topics. One is on deferred tax accounting. This is a very interesting topic because it's a interdisciplinary subject which involves income tax and also the financial accounting. We disclose this information in the profit and loss account debit side under the head income tax, and also balance sheet liability side and asset side as a deferred tax asset and deferred tax liabilities. This topic we are going to cover in the first session. In the second session, we are going to cover the foreign exchange accounting. To begin with, this is the aim of this presentation. First objective is to understand the two components of income tax expense in the profit and loss account. They are current tax and deferred tax. If you see the profit and loss account disclosed by any listed companies in their annual report, you can find two items in the profit and loss account debit side. One is current income tax expense and deferred income tax expense. We want to understand this concept. Second one is why deferred tax arises in accounting. Third one is why there is a difference between taxable income and pre-tax accounting income. Actually, we teach both subjects. Income tax we teach and also accounting also we teach. We find the taxable income under the Income Tax Act following the provisions of the Income Tax Act. We prepare the profit and loss account by following the provisions of the Companies Act and also the Ind AS, Indian Accounting Standards. So often we find the difference between these two items. One is taxable income and pre-tax accounting income or profit before tax. We will try to find out which are the differences for these two. These are the three objectives of my first presentation. And also next we continue the asking some questions. What is the permanent difference? How it arises? What is the temporary difference? How it arises? These are linked to the deferred income tax shown in the profit and loss account. This is the first we begin with what is accounting. If you ask what is accounting, accounting is defined in different ways. One of the definition of accounting is an information system wherein we have four items. One is input. Business transactions are the input for accounting. Process, we have accounting principles, policies, rules, regulations, standards, systems, etc. for preparation of journal, ledger, trial balance. This is the process. We get output in the accounting, output in the form of profit and loss account and balance sheet. We call it as a quarterly financial statements or annual financial statements. And finally, we are preparing these financial statements for the users. Users are the shareholders of the company, creditors, regulators, public, etc. This is the holistic approach to the accounting. It starts with input and ends with the users. While preparing the profit and loss account or while preparing the taxable income, we often refer to two important legislations. One is Companies Act 2013, another one is Income Tax 1961, which will be amended every year in the budget. These are the two important legislations we refer. When we look into the two acts, Companies Act 2013 and Income Tax Act 1961, there will be conflict between provisions of the Companies Act and Income Tax Act for recognition, measurement, and disclosure of elements of profit and loss accounts. In accounting, we use the term recognition. Recognition means we show some expenses in the debit side, we show some incomes in the credit side of the profit and loss account. Only when we receive the income or right to receive the income, we show it as an income. Only when we incur the expenditure or there is an obligation to pay the money for services we received, we show it in the profit and loss account debit side as outstanding expenses. And next we go for measurement. How to measure the expenses and income, assets and liabilities. There are different measurement methods are there. We use that methods. And finally, we disclose the expenses and income, assets and liabilities in the profit and loss account and balance sheet. There is a difference in recognition, measurement, and disclosure of expenses and incomes under the Companies Act, under the Income Tax Act. Why there is a conflict? This question would often arise among the commerce teachers. Tax information is provided to users through the annual and quarterly financial statements means you have a current year's tax liability on the debit side of the profit and loss account, deferred tax liability, deferred tax asset. This information is disclosed in the profit and loss account of the company. Taxable income. We prepare this taxable income, ascertain this taxable income under the Income Tax Act. While determining the taxable income, we apply the provisions of the income tax. There are specific provisions for measurement of income under different heads of income, 5 heads of income. Suppose you take the business head, there are so many provisions for admissible expenses, inadmissible expenses. If you come to the depreciation, for example, in the business head, Income Tax Act specifically says that we should follow the return on value method. Okay, so taxable income is computed to determine the amount of income tax an assessee must pay. Therefore, we have one concept called current tax liability. Current tax liability is the liability ascertained as per the Income Tax Act by following the provisions of the Income Tax Act for that assessment year, previous year assessment year, which is based on the rules and regulations framed by the government by amending the Income Tax Act in the budget. This is one concept called current tax liability. We ascertain this figure in Income Tax Act by following the provisions. If we come to the profit and loss account, tax liability of the company in the profit and loss account consists of two portions. One is current tax portion, which is current tax liability ascertained as per the Income Tax Act, plus deferred tax portion. These are the two discrete components in the profit and loss account. Current tax portion is the current tax liability. Deferred tax portion is the sum of deferred tax as liability and deferred tax asset. So there's a concept called deferred tax liability and deferred tax asset, which is shown in the balance sheet. Every year there's an opening balance and the closing balance. The difference between the opening and closing balance will be shown in the profit and loss account as deferred tax portion of the income tax. We have one concept called profit before tax. From this, we deduct the income tax payable, and then you find the profit after tax. We also call it as a pre-tax accounting income. Pre-tax accounting income is also called as profit before tax. Pre-tax accounting income has no effect on the amount of income taxes actually paid, as it is computed for financial reporting purpose. Suppose in the profit and loss account ratio, PBT, 1 crore rupees, less tax, which consists of two portions. One is current portion and the deferred portion. PBT has no relevance for determining the income tax liability because income tax liability is determined as per the Income Tax Act. But that expenditure is shown in the profit and loss account. So one argument is that pre-tax accounting income has no influence on the amount of income taxes actually paid by the company. The income tax amount is deducted from the pre-tax accounting income to determine the profit after tax. This is, we deduct the tax amount in the profit and loss account. Why there is a difference? There is a difference between taxable income and pre-tax accounting income. Taxable income is computed for tax per reporting as per the Income Tax Act, while accounting income is computed for financial reporting following the provisions of the Companies Act and Ind AS. Often these rules and regulations under the Income Tax Act and Companies Act differs for recognition, measurement, and disclosure of the elements of the profit and loss account. Taxable income follows the provisions of the Income Tax Act. Accounting income follows the provisions of the Companies Act, accounting standards, regulations, etc. There is a difference. Is it a timing difference? Timing difference means recognition of income and expenditure. Do we show the income and expenditure this year or the next year or the previous year? There is a difference in the timing difference between the recognition of expenditure and income in the profit and loss account under the two acts. What is the timing difference? Profit considered for tax purpose is different from profit shown in the profit and loss account. These differences are called timing differences. They originate in one accounting period and reverse in another accounting period. Means they will come in one profit and loss account of this year. The next year may they disappear because reversing the deferred tax asset and deferred tax liabilities. This is called timing differences. Types of timing differences. conceptually, there are two types of differences between taxable income and pre-tax accounting income. One is permanent differences and temporary differences. There are permanent differences between Income Tax Act and Companies Act and Accounting Standard, permanent differences. There are temporary differences between Companies Act provisions and Income Tax Act provisions. These are the two main differences which are called timing differences. What do you mean by permanent differences? A permanent difference is created when an income statement element, a revenue gain, expense or loss, enters the computation of either taxable income or pre-tax accounting income, but never enters the computation of the other. You please try to understand this permanent difference. If any revenue, expense or gain or loss comes in income tax calculation, total income calculation will never come in the profit and loss account. If any income or gain, expense or loss, if it comes in the profit and loss account, will never come in the taxable income. Means the difference is permanent. Okay, mutually exclusive. Which are the examples of permanent differences? For example, tax-free interest income. There are tax-free interest income and there is an interest income on which you have to pay the tax. Interest is tax-free on most government securities for tax purpose. Central government securities, we call it as a G-Sec securities. If any security carries tax-free, fines and penalties for violation of the law are not tax deductible expense under the Income Tax Act, while it is allowed under the Companies Act. Fine for delayed submission of the IT returns, GST returns, we show it as an expense in the profit and loss account, but we don't deduct it from the total income because this is inadmissible expenditure or income. So tax-free interest income is not considered for calculation of the total income, whereas it is shown in the profit and loss account in the credit side as tax-free interest income means it is an interest income. So there's a permanent difference between the total income calculation and the profit before tax calculation into the accounting. And there are some expenditure called disallowed expenses. Some expenses are disallowed while computing taxable income, but they are allowed under the accounting income. For example, goodwill written off. We often show the preliminary expenses written off, goodwill written off in the profit and loss account debit side. Suppose if you take goodwill written off in the calculation of total income tax officer will not accept your goodwill written off as a deductible expenditure. Or preliminary expenses written off is not a deductible expenditure. This is disallowed expenses. I've told you some of the few examples of permanent differences. A permanent difference is the difference arises when revenue or expense comes in profit and loss account, may not come in the income tax calculation of total income. Second difference is temporary differences. A temporary difference arises when the measurement rules for financial reporting as per Companies Act, Ind AS, differ from the tax reporting under the Income Tax Act. Means there are so many measurement rules. For example, valuation of stock, FIFO method, LIFO method, etc. Determination of depreciation, straight line method, WDV method, so many methods are there. So these are the measurement rules which are applied for computation of total income, and profit before tax differs from Companies Act and Income Tax Act. Because of the timing of recognition of revenue, gains, expenses, and losses, assets, and liabilities is different. Therefore, we call them as temporary differences. A temporary difference affects the computation of either taxable income or pre-tax accounting income in one period, and in subsequent period they reverse. This is very important definition of temporary differences. It is not a permanent difference. The recognition measurement rules are different. Therefore, in 1 year we show more expenditure, in the next year we show less. There's a set of one expenditure shown in 1 year more, in next year less. We call it as a reversing the differences in subsequent years. So this is called temporary difference. This temporary difference leads to deferred tax accounting. Wherever we find temporary differences. In fact, if I want to say something, in India, we follow dual financial reporting. Dual financial reporting means for income tax, one reporting, for accounting, another reporting. There are some countries where there is no difference between income tax law and Companies Act. They follow one set of accounting. Whatever the profit and loss account they prepare, on the profit they have to pay the tax in some countries. But in India, we prepare one set of profit for shareholders, one set of profit for income tax. Always we are poor for income tax office. We show less profit, less income to the income tax office in order to pay less tax. But we show more profit in the profit and loss account. We have to show the good picture to the shareholders. We give dividend, etc. Even though sometimes company may suffer losses. So this temporary difference affect the computation of either taxable income or the pre-tax account income in one period. Means in subsequent years, they may reverse. This is the meaning of temporary difference. Temporary differences are temporal. Temporal means they are not permanent. They arise in one year, they disappear in the next year. This is a chain, means this year arises, next year disappears. Next year arises, subsequent year difference disappears. The differences are temporary because they originate in one or more accounting periods and then reverses in one or more future accounting periods. For example, one of the important temporal difference in financial accounting and income tax is depreciation amount. We are showing in the profit and loss account, and this is also deductible expenditure under Section 32 of the Income Tax Act. How do you determine the depreciation amount under the two set of rules? A WDV method is used for computing depreciation under the Income Tax Act, while some alternative method is used for financial reporting, maybe straight line method. Okay. Larger amount of depreciation is deducted for tax purpose in the early years of an asset life, while lower depreciation is deducted in the later years under WDV method for tax purpose. So all of you are familiar with the WDV method, wherein we give more depreciation in the initial years of the asset life. When the asset life reaches reaches its end, we give less amount. Whereas in case of straight line method, we give the same amount of depreciation throughout the life of the asset. We take one example case study. Original cost of the asset is 10,000 rupees. Life of the asset is 10 years. Residual value is assumed as 100 rupees. What is the amount of depreciation under written down value method or straight line method? If we ask this question and find the depreciation amount, we will come to know how the amount of depreciation differs under the two methods. If the rate of depreciation is not given, depreciation is calculated under the straight line method using the following formula. Amount of depreciation which is equal to cost minus residual value divided by number of years of life. Here 10,000 is the cost of the asset. Residual value is 100 rupees. 9,900 divided by 10 years, which is equal to 990. Rate of depreciation 990 divided by 10,000 into 100, which is equal to 9.9%. Most of the time, we give rate of depreciation. Sometimes we don't give the rate of depreciation. In that case, we have to use the formula to find the depreciation amount and also the rate of the depreciation. This is under straight line method. If we put this amount in the table, suppose year 1, 2, 3, 4, 5, 6, 10, this is the life of the asset on the first column. In the second column, cost of the asset minus depreciation. 10,000 is the beginning amount. Depreciation amount is 990, which is constant throughout the life of the asset. We get a picture at the end of the 10th year. Residual value in the second column is 100, which is shown in the below, and depreciation amount is 9,990, which is shown for 10 years at rupees 990 per year. This is the straight line method calculation. Suppose if we go to the WDV method, under WDV method, if the rate of depreciation is not given, then it will be calculated by using this formula. As we are familiar with the straight line method to find the formula, rate of depreciation which is equal to 1 minus nth root of residual value divided by cost, where n is equal to number of years of life. So the formula is 1 minus 10th root of 0.01, which is equal to 1 minus 0.630957, which is equal to 36.9043%. Look at the rate of depreciation. Under the WDA method, rate of depreciation is 36.90%, whereas under straight line method is 9.9%. If we use this percent and find the depreciation amount, the table looks like this. First column, year 1 to 10. Second column, WDV, cost minus depreciation. Third column is the depreciation amount. If you apply the percentage, you get 3,690 in the first year. This depreciation amount decreases every year. Finally, we will have a 100 rupees residual value in the second column. Depreciation amount is 9,990. Please remember, please look at the third column. if the method of depreciation is different, straight line method or WD method, total amount of depreciation is 9,990 only. This expenditure remains same, irrespective of the method of depreciation, straight line method or WDV method. What is the difference is the amount of depreciation given in the 1 year, 1, 2, 3 varies. This leads to deferred tax asset and deferred tax liabilities. Now we have some hypotheses based on the two tables. Hypothesis number one is total amount of depreciation provided under WDV method and straight line method is 9,900 for the life of the asset. All of you would agree for this statement. Total amount of depreciation never change. By changing the method of depreciation, it remains same. This is the first hypothesis. The second hypothesis is there is a difference in the amount of depreciation provided in each accounting year under WDV method and straight line method. Means amount of depreciation under WDV method and straight line method for each year varies. Under straight line method, we are giving 9,990, whereas in 990, whereas in case of WDV method, we give more amount in the initial years, less amount in the later years. So amount varies between the years. These are the two hypotheses. And the third hypothesis is WDV method provides more depreciation during the first 3 years. Means just you count the amount, total the amount, 3,690 the first year, second year 2,329, third year 1,469. Means 4 digits in the first 3 years. Later on 3 digits. Finally, it comes to the 2 digits. So life of the asset is cost of the asset is 9,000, 10,000 rupees. Depreciation amount is 9,990. In this, we are giving more depreciation in the first 3 years, while it provides less depreciation during the next 7 years. 2004, 1, 2 means almost 75% of the depreciation amount is given in the first 3 years, and only 24% is given in the next 7 years. So distribution is different in the WD method. Hypothesis 4 is straight line method provides equal amount of depreciation in each accounting year, that is 990. This measurement of depreciation amount for the asset under two methods, which is followed by the two sets of acts, means the WD method is followed strictly under the Income Tax Act, whereas in accounting, Companies Act may prefer to follow straight line method, not compulsory. This leads to deferred tax accounting. This is a picture of two comparison of the WD method and SLM method. In the first column, we have seen 1, 2, 3, 4, 10 years. In the second column, you have written the depreciation amount under the WD method, 9,900 total. Depreciation in the straight line method is given in the third column, total 9,900. In the fourth column, we find the difference in the depreciation amount for each year. Suppose in the first year, 3,690 minus 9,990, you get 2,700 extra depreciation given after the first year under straight and WD method. Like this, if you find in the difference, first 3 years positive, in the next 7 years you find negative, totally zero. Zero is very important. I said temporary differences arises in 1 year, it reverses in the second year. 2,700 is the difference arised in the first year. 1,339 is arised in the second year. 479 arised in the third year, but it reverses in the subsequent years. Finally, we say there is no difference in the depreciation amount given under straight line method and WDV method. That's why the amount of depreciation is same under straight line method and WDV method. So this is the comparison of WDV method and straight line method. Next, larger amount of depreciation is deducted for tax purpose in the early years of an asset life, while lower depreciation is deducted in the later years under the WDV method for tax purpose. Higher depreciation amount deducted under IT Act during first 3 years of asset life. Sorry. Higher depreciation amount deducted under the IT Act during the first 3 years asset life, 4,518, is reversed by deducting lower amount of depreciation during the next 7 years. This is minus 4,518. Means plus 4,518 minus 4,518, which is equal to 0. So sum of the difference for 10 years is 0. This table is very important. If you add the first 3 years total plus next 7 years total, which is equal, finally we get 0. These are the inferences we draw from the three tables. This is one example I had given you, the depreciation amount, elaborately how we measure the depreciation under two methods and how it leads to the temporary differences. There are many temporary differences. One is prepaid expenses, accrual system of accounting and cash system of accounting. We follow two system of accounting. Accrual system of accounting, prepaid rent, insurance, similar items are reported as assets and expensed over the period of usage for financial reporting. So we show in the asset side, prepaid rent as an asset, prepaid insurance as an asset. Okay. Whereas in cash system of accounting, they are deducted for tax purpose under cash system of accounting. In Income Tax Act, they follow cash system of accounting. They don't follow the accrual system. But in accounting, we have accrual system of accounting because we have accrual concept wherein we determine the profit for the period. We exclude the expenses, incomes of the next year, of the earlier years. Our accounting period is very important for determination of the profit under accounting. Whereas in Income Tax Act, the income may be related to previous year or the next year. Whenever they receive the income that is taxable in this previous year, therefore, cash system of accounting is followed in the Income Tax Act. This leads to temporary differences in Income Tax Act and Companies Act. Prepaid expenses, if you take the example, it has two components. One is current portion, which is expense, deferred portion, which is asset. Suppose we have insurance expense. Insurance expense means we have to pay the insurance premium in advance for 1 year. Suppose company has paid the vehicle insurance in the 1st March 2024 for 1 year. For this financial year, we have to show only 1 month insurance expense. In the remaining 11 months expense is shown as a deferred portion in the asset side as an asset. So this is prepaid expenses two portion. One is current portion and the deferred portion. For example, free paid rent on 1/3/20 is 7,000. Rent per month is 1,000. 6 months rent for April 20 to June 20 is paid in advance. Under financial accounting, 1,000 is shown as an expense for financial year 1920. 6,000 is shown as an asset as on 31st/3/20. Under income tax reporting, 6,000 is shown as an expense. You see the difference in cash system of accounting and accrual system of accounting. We are following under two sets of rules. Another example is incomes received in advance. Rent received in advance is reported as liability and later it is shown as an income under the accrual basis for financial reporting. But they are shown as income for tax purpose under the cash basis. So there are so many such examples in the income tax law and also the Companies Act, financial reporting, where the differences arises in one financial year, reverses in this subsequent years. We are interested in what is the impact of temporary differences. Temporary differences originates in one accounting period and are sometimes referred to as originating differences at that time. I think we have seen in the calculation of depreciation under the W method and the Strickler method, in the first year, there's a difference arises. This is called originating differences. In the later years, they will reverse. They turn around or reverse in one or more future periods and are referred to as reversing differences. We have two types of differences. One is originating differences. Second one is reversing differences. Finally, the originating differences will set off with the reversing differences. Finally, we get no difference at all if you see holistically for the 10 years period of the asset life. Now, these temporary differences lead to two conceptual items. One is future taxable amounts. In income tax and in accounting, if you make a comparison, if you study together two subjects, one item would arise, this future taxable amounts. Future taxable amounts are temporary differences that increase taxable income relative to pre-tax accounting income in future periods when reversal occurs. There are two concepts. One is future taxable amount. Second one is future deductible amounts. Future temporary differences that decrease taxable income related to pre-tax accounting income in future periods when reversal occurs. So we have two concepts. One is future taxable amounts and future deductible amounts. This is because of temporary differences arise between taxable income and profit before tax. I summarize these examples in the table. Our title is Future Taxable and Future Deductible Amounts. In the first column, common sources, revenues or gains are included in the pre-tax accounting income, but not in the taxable income. Example, interest income accrued but not received. We say outstanding incomes. We are showing in the profit and loss account credit side. We are considering it as a revenue recognition, but it results in deferred tax liability because we are not paying tax on that in that year. We are showing it as an income in the accounting, but we are not paying tax because income tax doesn't accept this. Income due but not received is not accepted in the Income Tax Act. Therefore, it results in deferred tax liability. Revenues gains are included in the taxable income but not in the pre-tax accounting income. For example, interest income not accrued but received in advance, income received in advance, it's a deferred tax asset. Means in this case, Income Tax Act considers this a total income and pays tax, whereas in accounting it is not considered. Rationale for differences, cash system of accounting versus accrual system of accounting leads to two concepts. One is future taxable amount and future deductible amount. Similarly, you take the profit and loss account debit side expenses. The common source of difference in the debit side is expenses or losses are deducted for taxable income, but not in the pre-tax accounting income. For example, expenses paid in advance, we call it as a prepaid expenses. That results in deferred tax liability. Another one is the expenses or losses are deducted for pre-tax accounting income, but not in taxable income. We call it as expenses due but not paid. This is called outstanding expenses, which results in deferred tax asset. What is the rationale for differences? This is cash basis of accounting versus accrual basis of accounting. We have seen two sides. One is income side and debit side and credit side. How the expenditure shown in the debit side and the credit side income is shown results in the deferred tax asset and liabilities when you compare with the taxable income with the pre-tax accounting income. What is the conceptual basis, theoretical basis for this classification? The conceptual basis underlying accounting for deferred income taxes is the measurement of the future economic tax benefit. Means whether any expenditure, any element of profit and loss account, maybe expense or loss or income or gain results in future taxable benefit or future obligation to pay the tax. This we are very much concerned about this. Benefit, tax effect is tax benefit or tax obligation that arises from the current temporary differences. We have a method called asset liability method, which has been recommended by the income tax Ind AS. The asset liability method is used to account for temporary differences. Under the asset liability method, the future tax consequences arising from the temporary differences existing at the end of the accounting period are recorded as either deferred tax asset or deferred tax liabilities. This is starting from 1st April of the accounting year to the end of 31st March of the end of the year. We determine which are the temporary differences and whether the temporary differences results in deferred tax asset or deferred tax liabilities. We have to calculate it and we have to show it in the balance sheet, and also the difference is shown in the profit and loss account. So what do you mean by deferred tax liability? We already understood the concept of deferred tax liability by an examples. Future taxable amounts result in future tax obligations because they cause an increase in the taxable income related to pre-tax accounting income. It is called deferred tax liability. They are referred to as a deferred tax liability. Simply means all future taxable amounts results in future tax obligations. They are called deferred tax liability. What is deferred tax asset? Future deductible amounts from the taxable income, which reduces the taxable income. It results in obligations, reduced obligations. Therefore, we call it as a deferred tax asset. Means all future deductible amounts would reduce the taxable income. Therefore, it reduces the future tax obligations. We call it as a deferred tax asset. These are the two concepts. One is deferred tax asset and deferred tax liability. The deferred tax asset or liability measures or estimates of the future tax cash flow consequences of existing temporary differences. All companies will have temporary differences in every financial year. We have to estimate whether there is a cash inflow or cash outflow because of the temporary differences, which results in the tax benefit or tax obligations. Based on that classification, we classify them as deferred tax asset or deferred tax liability. Now we come to the current portion of the income tax. As I told you in the beginning, the profit and loss account debit side, PBT minus tax, which has two portions. One is current portion and the deferred portion. What is the current portion of the income tax? Current portion of the income tax expense for a accounting period or a previous year is computed on the basis of the heads of income under Income Tax Act and applicable deductions. This is purely as per the income tax we have to calculate. We don't mix with the Companies Act or Ind AS. Tax payable or refundable for the year is the current portion of the income tax expense or savings. Sometimes company incur losses, there is no tax obligation. Sometimes company makes profit, company has to pay the tax. And we have a set off and carry forward of losses. Even though there's a profit in this year, because of the set off and carry forward of losses, there can be a refund amount from the income tax office. So we call it as a current portion of the Income Tax Act. This is calculated as per the provisions of the Income Tax Act. We have another portion in the profit and loss account. This is called deferred portion of the income tax. The changes in the balances of deferred tax asset and deferred tax liabilities amounts from the beginning to the end of the accounting period are included in the deferred component of the income tax expense. Deferred portion is simply the difference between opening balance and closing balance of deferred tax assets and deferred tax liabilities, which are shown in the balance sheet. So now we can make a comparison here. Deferred portion of the current year's income tax in the first column, temporary differences at the end of the year multiplied by tax rate. Deferred tax asset closing balance, deferred tax liabilities closing balance. The second one is temporary difference at the end of the last year multiplied by last year's tax rate, because tax rates are not same in the same year. It varies. Sometimes it remains same. Opening balance and opening balance. You deduct deferred portion of the current year's income tax savings. Second one is current deferred portion of the current year's income tax expense. Net effect is, if deferred tax asset is more than the deferred tax liability, then current year's income tax payable is less. If the deferred tax liability is more than the deferred tax asset, then current year's income tax payable is more. This is the deferred portion, is how we calculate by comparing the closing balance and opening balance of deferred tax asset to deferred tax liabilities. We can have a formula for this. Our formula is deferred tax portion of the income tax expense or savings can be increase or decrease in the deferred tax liability plus increase or decrease in the deferred tax asset multiplied by the tax rate. So we have a formula: total income tax expense, which is equal to sum of the current year portion of the tax plus deferred portion. For example, this is a case study. X Limited has the following information for the year 22-23. Corporate tax rate is 25%. Pre-tax accounting income, this is PBT, is 4 lakh rupees. Taxable income is 2 lakh. One item is prepaid insurance premium, 20,000. This is a temporary difference. Prepaid insurance premium. We are accounting for this under the accrual system in the financial accounting, whereas in cash system under the Income Tax Act. These are the simple example we have taken. Current year tax, for example, taxable income is 20 lakh rupees, 2 lakh rupees. Tax rate is 25%. 50,000 is the current portion. Deferred tax asset at the end of the 2021 year is temporary difference multiplied by tax rate. Suppose if we assume that there is no opening balance and only one temporary difference is there, 20,000 to 25%, 5,000. Finally, we can say that income tax payable, which is equal to current year portion 50,000 minus deferred portion 5,000, 45,000. Why we are deducting it? Because this is a deferred tax asset. So asset is a benefit we are deducting. So 45,000 is the income tax payable. Now, why this issue arises? This deferred tax arises in the accounting, profit and loss account and balance sheet. There are so many issues and also there are solutions. Number one issue is dual reporting regime. One set of rules for tax reporting, another set of rules for financial reporting we are following. For example, India is following this. There is no rules, one rule for either income tax and for financial accounting. This presence of dual set of rules results in deferred tax accounting. Single reporting regime. Presence of single set of rules both for taxable purpose and financial purpose would eliminate the deferred tax accounting. Suppose we are all getting salary. Whatever the salary we get, we have to show to the income tax office and we pay the tax. I cannot manipulate my salary income. It is known to everyone. Whereas in case of company, the profit measurement varies. They show one set of profit and loss account for tax purpose, another set of profit and loss account for shareholders, equity shareholders. This is given under the Act. This is called dual reporting regime. This is one issue. We take one example case study of tax reporting of Reliance Industries Limited financial statement. Suppose you take, this is the picture, the figures related to 1721. Profit before tax. Reliance Industries, now they are making more profit. In 2017, 40,777 crores. This is PBT. You see, look at the profit figure. Average figure is 40,268. Current portion of the tax, 8,335, 893. This is calculated as per Income Tax Act. 21, 0. Even the profit is there, the tax current portion is 0. Deferred tax portion 1,109 crores, 1,019 crores, 3,160 crores like this. Here in this case, you see 4,732 crore. 885 is the deferred tax portion. Income tax paid 2 plus 3. This is the income tax paid. What is the income tax rate? 34%, 34% like this. Current taxable income. This is 24,081 like this. Temporary difference 3 minus 5 means these are the calculation of how the temporary deferred tax portion arises by deducting current taxable income. This is 3 is the deferred tax portion plus 5 is the income tax rate. This is shown in the Infosys Technologies balance sheet, profit and loss account. Current tax 8,167, 21. This is 6,690. Deferred tax is 208,300. Income tax expense. This is the page number, and like this it is shown. So when they are showing in the profit and loss account deferred tax like this, we have analyzed this, how the deferred tax is calculated, how it arises in the financial statements. So information given in the annual report of Infosys. Suppose if you see the notes to accounts of the Infosys, income taxes are accrued in the same period in which the related revenue and expenses arise. A provision is made for income tax based on the tax liability computed after considering tax exemptions and allowances. This is provision for tax, income tax. The difference in that result between the profit considered for income taxes and profit as per the financial statements are identified. Thereafter, a deferred tax asset or deferred tax liability is recorded for timing differences. This is shown in the annual report of the Infosys, how they determine the deferred tax asset and deferred tax liabilities and deferred portion of the income tax. The differences that originate in one accounting period and reverse in another based on the tax effect of the aggregate amount of the timing differences means there are so many temporary differences are there. Aggregate figure is taken and the timing difference is ascertained and tax rate is applied to find the deferred tax asset or liability. The tax effect is calculated on accumulated timing differences at the end of the accounting period based on the enacted or substantially enacted regulations. Deferred tax assets in situation where unabsorbed depreciation and carry forward business losses exist are recognized only if there is a virtual certainty supported by convincing evidence that sufficient future taxable income will be available against which such a deferred tax asset can be realized. Means we cannot simply show the deferred tax asset in the balance sheet because balance sheet figure will be inflated by showing these two figures. So when you show the deferred tax asset, you are sure that the future taxable amount, future deductible amount are available. Therefore, we can set off this amount in the profit and loss account. Deferred tax assets, other than the situation of unabsorbed depreciation and carry forward business loss exist, are recognized only if there is a reasonable certainty that they will be realized. Deferred tax assets are reviewed for the appropriateness of their respective carrying values at each reporting period. This is the accounting policy statement of Infosys Limited. Very detailed the presentation they have made. If you read the notes to accounts, you can understand how they calculate this figure, especially in case of Infosys Limited. So this is my presentation.